You know, if you're an investor, you have definitely faced this exact problem. You've got a chunk of money, it's ready to invest, but what do? Do you put it all in the market at once, or do you kind of drip feed it in over time? Well, that is the huge question at the heart of the SIP versus lump sum debate, and today we're going to settle it.
So really, what's the right move? I mean, diving in headfirst feels pretty bold, right? Decisive, but wading in slowly, that feels safer, more cautious. And you hear all these passionate arguments for both sides, which is exactly why it can be so confusing to figure out what's best for you.
But that's what this is all about. We're going to cut right through all of that noise. We're going to break down exactly how each of these strategies works and give you a super clear way to decide what's right for your own financial journey. So let's get into it.
When you really boil it down, this debate is a choice between two very different approaches. One is built for speed, and the other is built for stability. All right, so let's meet our two contenders.
Okay, first up, we've got the lump sum. And yeah, it's exactly what it sounds like. This is about investing a big amount of money, say a work bonus or maybe an inheritance, all in one single shot. It's one big, decisive move to get your money working in the market right away.
And in the other corner, we have the SIP, which stands for Systematic Investment Plan. Now this is the slow and steady approach. Instead of one huge investment, you're committing to investing a smaller, fixed amount of money on a regular schedule, like clockwork, every single month. It's disciplined, it's consistent, and best of all, it's automated.
All right, let's really put them side by side. A lump sum is a one-time thing, right? It's perfect for when you get a sudden windfall of cash. An SIP, on the other hand, is literally built for the steady rhythm of a monthly salary. It basically swaps the stress of trying to time the market with the simple power of a disciplined, automated habit. You can just set it and forget it.
So what's the big appeal of going lump sum? Well, in one word, compounding. I mean, think about it. Your entire chunk of cash is working for you from the very first day. If the market is going up, this means more of your money is growing for a longer period of time, which can lead to way faster returns. It's a strategy that's really betting on immediate growth.
But, and this is a big but, that speed comes with a huge risk. If you invest that large sum and the market immediately tanks, your entire portfolio takes a massive hit all at once. You're basically making one single, high-stakes bet that your timing is perfect. And if it's not, wow, the short-term pain can be pretty brutal.
Now, let's talk about the beauty of the SIP. Its real superpower is something called rupee cost averaging. Here's how it works. Since you're investing the same fixed amount every month, your money automatically buys more shares when prices are low and fewer shares when prices are high. Over time, this just averages out what you pay and smooths out all those scary ups and downs in the market, and you don't even have to think about it.
Of course, there's always a trade-off. All that stability means you might not capture the explosive gains you'd get from a perfectly timed lump sum investment. You know, if the market just takes off like a rocket in a massive bull run, your slow and steady SIP is probably going to underperform someone who went all in right at the bottom.
Okay, so we've seen the pros and cons of each, but here's the most important part, the thing a lot of people miss. You don't actually have to pick just one. The smartest investors know this isn't an all-or-nothing choice. It's really about building a strategy that fits your life.
You got to think of these as different tools for different jobs. Look at your own situation. Are you earning a steady monthly salary? Then an SIP is the perfect tool for you to invest consistently. But what if you get a big bonus or sell a property? Well, that's a classic case for a lump sum investment. And hey, if the market just feels way too crazy and unpredictable, the SIP is your best friend for navigating that uncertainty.
So, the real answer isn't one or the other. It's both. The smartest strategy is to blend them. You can have an SIP running in the background, consistently investing from your salary, and then deploy a lump sum when you get a sudden windfall. See? They're not opponents, they're partners in your portfolio.
All right, as we start to wrap this up, let's boil it all down to the one core idea you should absolutely remember long after this is over.
It all comes down to this one simple idea. SIP gives you stability. Lump sum gives you speed. If your main goal is to build a disciplined, steady habit, the SIP is your go-to tool. If you're ready to take on a bit more risk for potentially faster growth, then a lump sum is the right tool for that moment. It's all about matching the tool to what you're trying to achieve.
At the end of the day, whether you choose an SIP or a lump sum for any particular investment, the real secret isn't the method itself. The magic is just in the consistency. The most successful investors are the ones who just stay in the market and keep on investing, using whatever tool makes the most sense at that time.
So we'll leave you with this.
You now know the how for both SIP and lump sum investing. The only question left for you is what's your when? The best time to start was yesterday. The next best time is right now.